Hello and welcome back to KD's Business Tips. Michael Lapede here on a small series on trusts, the basics of trusts, and talking a lot about family trusts particularly. But a couple things you want to know about a trust. Let's first of all recap on what the definition of. It was agreement between parties, a legal arrangement between a settlor and a trustee or multiple trustees on behalf of the beneficiary. Let me give you two examples of a trust. There's many types of trusts. So one example would be an RRSP. When you first put that money into an RRSP, you're the settlor. You put the money into your RRSP. Then there's a trustee who's going to manage that. That could be Royal Bank, Investors Group, CIBC, Scotia, whoever's managing whatever the trustee is, they're the trustee managing it on behalf of the beneficiary. They're going to say, name a beneficiary. The first beneficiary is the government of an RRSP. They're automatically a beneficiary because if they have to take the RRSPs, they will. But you get to name your other beneficiaries. So that is agreement that is legally binding and is considered a trust. Another one would be a will. So when someone passes away, all their assets get settled into a trust. Okay, that's where probate happens. And this is called a testamentary trust, which we'll talk about in a moment. But that's the settlor. The person that passes away is the settlor in this trust. Then we have a trustee who manages that on behalf of the beneficiaries, and that is called an executor. The trustee in this case is called the executor of this. That's the trustee of this trust. And the beneficiaries are all the beneficiaries of the will, right? So those are two examples, simple examples of trust. And really there's two types of trusts. There's testamentary and there's inter vivos. Testamentary means someone passed away. When someone passed away, that is a testamentary trust. Virtually most other trusts are almost all inter vivos, all the main trusts. There are some other types of trusts that fit within those categories and subcategories, but most trusts are inter vivos unless someone passed away, and that's when you have the testamentary trust, okay? And the testamentary trust has special rules because that person, when they pass away, they still get some of those graduated tax rates that they got on their personal tax return, whereas a trust doesn't get that normally. A trust just automatically will pay the high rate. Whereas individuals, they will pay a lower rate. So when they pass away in their first year, that graduated testamentary trust gives them all those tax brackets for lower taxes. So a testamentary trust has some benefits and is really just mostly used to wrap up someone's estate when it's dragging on. Because if you can just file the final tax return and there's really nothing carrying over, then you just don't have to worry about a trust. But if it drags out for 2 to 3 more years and you've already filed the final tax return, there's still income coming in, still assets being distributed, that's when you would want to file for the testamentary trust. Now we're going to go more into trusts in the next videos, but if you got any questions at all, we'd love to hear from you. Subscribe if you haven't to, and we'll see you back here soon.